Good afternoon, everybody. Welcome back. We are here for another week of information. Today, we're going to be discussing the Vancouver real estate market as an investment, as opposed to ye old stock market.
That was the worst introduction of all time.
That's perfect.
The worst introduction of all time. But yeah, we're going to be talking about whether you should go for real estate or whether you should take a look at the stock market, and or when is one better than the other, and breaking these things down. I think there's so many different vehicles to the proverbial financial freedom. People are kind of taken by awe or shocked or surprised at how each one works in order to get you to that metaphorical road of financial freedom.
Road to success.
Road to success, yes. So, I mean, first and foremost, both have their pros and both have their cons. So, obviously, I think there's a lot of stigma with the stock market that people just don't know. People just don't know. They don't follow economic trends. There's always that fear of, I'm going to put 10,000 in or even 5,000 and it's going to go to zero and I've lost everything.
Yeah, and there's been a lot more volatility in the stock market in general, both US, I think, and a little, obviously Canadian as well, but a lot more volatility than the real estate market has seen in the last 10 to 20 years.
Yep.
So that also puts, I think, that fear of what if, in conjunction with a few other details which we can go into.
Yeah, so I mean, first of all, starting with the stock market side of things, I think a lot of the reason why people are geared towards the stock market is you don't need that high amount of capital in order to get started. I mean, you can build over time. You can have $100 here, $100 there, and you can slowly add over time. And if you're looking at things like penny stocks, you could get thousands of shares for just $1,000. Whereas obviously real estate, on the other hand, typically needs a larger amount of capital, put forward a down payment in order to then start looking at renters to come in. Then you're trying to look at being cash positive. It's a harder road to get started on, in my opinion, than the stock market.
It's definitely a harder road to get started on because the amounts of money needed for the deposit are, of course, bigger. I think it also comes with real estate as opposed to the stock market. The point of leverage is very important. And that can go either way, of course. But typically when people invest or gamble with money in the stock market, it's dollar for dollar. So you're taking your own cash. If I've got $5,000, $10,000, I'm putting $5,000 or $10,000 in. And we're not going to go into any of the further details, but if we're just going to look at base level, I'm buying a stock and I'm assuming it's going to go up, or I'm buying a stock and I'm wanting to reap the rewards of those dividends as an investment. So if I put in 5,000, I've got 5,000 invested. With real estate, you put in 5 to 20% and you get the difference made up from the bank. So if you buy a $500,000 piece of real estate with 10% down, your leverage is on the whole price. So if the market goes up 10%, it goes up 10% on $500,000, not just on the 10% you've got in there.
Yeah. So I think when you look at the stock market is, so a big thing that we like is like dividend investing. Okay, that's not the only route of going down stock market investing. That's just one of our favorites. And essentially being, for those who don't know, is you will purchase a share in a company. So I think as of writing this, TD was trading at $61.40 a share. They will pay you an annual dividends of $3.19 per share, which is, I believe, 79 cents, very quick math, quarterly. And obviously the more shares that you have, the more that amount builds up and up and up. So in order to get that $2,000 a month or $24,000 a year figure, you'd need about $465,000 invested, which, again, quick math, is about $7,525. I definitely wrote this all down before, so when I say quick math, I'm 1,000% lying and just memory based. But that's about $465,000. Now that is a lot of money, don't get me wrong, but as you can add to that, $100 here, $100 there, maybe $60 here, $70 there. Maybe one day you can add $1,500, something like that. The idea is you're building to that point where you get that passive income. Now, on the rental side of things, it's assuming you're looking at property from an investment standpoint, the rental side of things is a lot harder because it's not just that initial investment that you have to put down in terms of your down payment, but you've got mortgages. If you're in a strata, you've got maintenance fees, the property taxes, various other fees as well. So it's not just once you put the down payment down, you're getting your $2,500 a month in rental. You're also sometimes, especially in Vancouver, you're having to look at a 30, 40, maybe even 50% down in order to be cash positive, i.e. money left over after mortgages, bills, etc. afterwards.
Yeah, we had a client, the most recent one was a condo down in Chinatown. The condo was $620,000 for a 1-bedroom. Rent was assumed to be about $2,100 a month, if my memory serves. And we had to put down 49% to break even. So to just get zero every month after strata, insurance, of course your mortgage costs, allowing $100 or so a month for issues and all that sort of stuff. So with regards to Vancouver real estate, we're finding a lot of people are investing in Vancouver real estate, but they're not positively returning cash flow like you would, for example, with the dividend stock.
Yeah.
They are assuming or banking on the equity to grow as opposed to getting that paycheck every month, which everyone has their own risk reward tolerance levels. That's just what the market has become here. Obviously rents have increased, but nowhere near the increase of capital pricing. So we find ourselves in those predicaments. So an investment in real estate is going to lean, typically speaking, a lot more towards you're now in and you're going to expect that capital appreciation, as opposed to you're now in and you're actually getting cash handed to you every month as a return.
That kind of leads on into a nice segue as to the next point. So far, I mean, we've really said the stock market, I mean, on average, I think it increases about 7 or 8, possibly 9, I think it's 7 or 8% year over year on average. So you can add to that slowly. You don't need to worry about your credit score, a down payment. So it seems at the moment we're very pro stocks. And while that may be the case, taking a look at real estate, you would maybe be questioning why would anyone kind of go into real estate when we talk about that. And I think that capital appreciation is what you're talking about, essentially for your 10, 20% down. In 10 years time, it's, especially in Vancouver, it's not uncommon to see your appreciation of that home on the full amount double or more. We've given multiple examples of around downtown where 2008, 9, 10 pricing was 600, 650, 700, and those homes are selling for like 1.2 million plus now.
For sure. And another layer of all this, I think, which leans to the real estate side, is it's an asset you can touch. So there's more flexibility with it. If I buy stock in TD, for example, I have no say what happens at head office in TD, and I have no say what happens with the market. I just watch the pricing either go up or go down or stay flat. With the real estate, we can live in it, we can rent it out, and we can renovate it. Yeah. So there's a lot more tangible options, I'll say, that I think is another huge reason why, in addition to the numbers and everything, why people have such belief in real estate, especially in this city, is because it does give you options. You don't just buy and wait or buy and have that percentage trickle in, but if you need to move into it because you want to or have to, you've got that option. If you want to rent it, assuming the restrictions in the building, you've got the option. And if you buy something a bit older and renovate it, you can add equity, of course, and either sell it at a premium or rent it out at a premium.
Yeah, so it's, I think, going back to one of your points, but you can actually touch it, is there's that age-old saying is like, real estate is safety. Real estate is one of the safe investments because no one can come and pick up your real estate and move it. But not that anyone can essentially do that with your stock, but like you said, you don't have an impact, you don't have a say. It can manipulate up or down in a variety of different ways. On top of that as well, once you get into real estate and you're seeing that property appreciate, there's relatively little upkeep beyond the regular maintenance side of things. I think a lot of people get put off entirely on stocks because they don't follow economic trends. They're not understanding what going short and long is and the variety of different ways you can get in the stock market. And I think that makes people fearful when they think, okay, real estate is safe, it's here, I can see it, I can vet the tenants who are coming in. And then idea being is that they pay on time, there's little to no maintenance on the property other than regular, and then it's just done. I don't have to worry about it. And again, they're paying off your mortgage and fees, and your property is appreciating at the same time as well.
Yes, I can't add to that. That's the same thing. And
so
it's, yeah.
Well, and so I think that's part of the appeal. And so I think when it comes to whether you should do one or the other, I think in our opinion, we say you should do both.
I think you definitely need to be both, not only for the perspective of, I mean, we're not going to nail down into all the values as we were discussing yesterday, first-time buyers, there's RRSP advantages, there's tax savings when it comes to that. But I think there's definitely an advantage to diversifying your life and portfolio, if you will. And Vancouver real estate has performed a certain way to date. Does that guarantee future performance? Definitely not. The same with any stock to date. Nothing's guaranteed and no one has that crystal ball, but to be diversified out, and I think on multiple levels as well. If you get into the real estate market in downtown, for example, you're getting in at essentially, I mean, you can get in cheaper, but let's call it $500,000 and whatever down cash equity you have into that, plus the mortgage. And on a smaller scale, and most times you've got the flexibility of the stocks, buying multinational, international, or just national companies to have that payment coming in. I think the diversity is key.
And let's not like skim over the obvious. If you've saved up and you've put 20 or 30 grand into the stock market and then share prices come down, and if you were to pull it out that same day, you've put 20 or 30 in and now it's only worth 10 or 12, that's a hard bullet to take. And the key is, and we're not going to dive too much into this because we're already approaching on time and you talk too much, but picking yourself up and then just going back at it again is probably one of the hardest things to do, because inevitably you will lose in the market if you're in it for the long haul for a long enough time.
One last point I want to make to that exactly, the emotional tie to the money in the market is a lot easier to react on when you can just open up your phone and say sell. It's dropping, it's down 5, 10, 15, sell. The real estate side, it does not move that quickly by the second in front of your screen if you're watching these charts, for example, in the market, and there's a process involved in selling, and it's a lot more expensive to sell.
That's it.
So, yeah.
So we would say venture into both, use both vehicles in order to build that wealth and that financial freedom. And of course, we're not professional stockbrokers, but on the real estate side, if you have any questions, reach out to us. We'd love to have a chat. But until next week, we are out.
Thank you.
Thank you. Bye-bye.